it's likely, more than likely, in fact, almost bank it, that the RBA will cut rates today. But what does it mean for the rest of the year? Joining me live is AMP Deputy Chief Economist Diana Mousina. Diana, thanks so much for your time. So let's talk about the cut, yes, because a lot of mortgage holders are really sweating on that today. But what are we likely to hear from the Governor, Michelle Bullock, about the state of the economy and where rates are going?
Well, what we have heard from the Reserve Bank is that they don't want to sound like they are going to be cutting interest rates in a fast way in the next 12 months. So they do still sound a little bit, I guess, cautious that they don't want to signal a much faster rate cutting cycle, which could mean this rebound in inflation, which is really what they're trying to control. They don't want price growth to become uncontrollable again like it was 18 months ago. So I think the Reserve Bank is still going to sound quite cautious about the outlook. They'll, of course, mention the global uncertainty. And then, of course, I think that they'll justify today's rate cut by saying that the economy needs more support, particularly for the household sector, because all the data that we've had in the past 2 months has really signalled that the household remains under pressure.
Yeah, that's certainly the case as well. So, I mean, when you look at the data, I mean, the bright spot is that the jobs are holding up. People aren't losing their jobs in the tens of thousands, but economists somewhat are perhaps think that may not last forever. But what does it mean for further rate cuts this year and where we are in the cycle? Because we spoke to Shane yesterday, Diana, and basically it takes about 12 months for any rate cut to follow through fully. So perhaps the RBA is a bit too late to cut.
Well, if you study econometrics or economics, they would tell you that rate cuts and rate hikes work with about up to an 18-month lag.
Yeah, well.
So we're just at the starting point of that rate cutting cycle. We've already had 2. We think that, including today's rate cut, we're going to get another 4 from here. So basically, we see the cash rate ending somewhere at just under 3% after a peak of 4.35%. So I don't think that the RBA has been necessarily too late. I mean, we were expecting rate cuts to start in late 2024. So we would have liked to see them start a bit sooner. But as you said, the labour market is still holding up quite well. And we did have this quite high level of services inflation only 12 months ago. So I understand the RBA's caution. And I don't think that we're necessarily in a state where we're about to enter a big downturn, so we need to be quickly cutting interest rates. I just think that we need to give the economy a bit more support and to take away some of those rate hikes that we had in the past 2 years.
And just quickly, how much will Trump, whatever you're talking about, whether it's tariffs or other big decisions he's making in the US, how much will that feed into the conversation today around the boardroom table?
Of course, they'll be taking it into account and looking at where the average US tariff rate is going to. But to be honest, I think that Australia is only 4 or 5% of US total imports. We're such a small share of that. Our baseline tariff rate is not going to be very high. We're not really going to be impacted directly. And I think even the indirect impacts from potential flow into China is going to be quite minimal, because I do think tariff rates are not going to be as high as where Trump and his team initially proposed them to be after Liberation Day. So I think the worst actually is over around tariffs, but maybe I'm too optimistic.
We like optimism, Diana. Thank you for that. We'll check in with you soon. Appreciate it.